Welcome to Mad Money. Today we're diving into why stocks decline after certain triggers. You see that ticker flashing red? That, my friends, is the sound of dreams getting crushed, portfolios taking a nosedive, and investors hitting the panic button. But fear not, we're gonna break it down Kramer style, so you can understand the why behind the drop. Because on Mad Money, knowledge is power, and power, well, that's what separates the bulls from the bears. Let's go. We've all been there. The market's humming along, your portfolio's looking like $1 million, and then bam! The Federal Reserve hikes interest rates, a geopolitical crisis erupts, or some other unforeseen disaster strikes. Suddenly, fear grips the market like a vice. Investors, those skittish creatures of habit, start seeing red everywhere they look. They dump their stocks faster than you can say margin call, desperate to salvage what's left of their portfolios. It's a stampede for the exits, a fire sale of epic proportions, and guess what? It sends stock prices plummeting like a piano off a skyscraper. Imagine this, a stock's been on a tear, skyrocketing like a rocket to the moon. It's the kind of meteoric rise that gets everyone talking, from seasoned investors to casual market watchers. The financial news is abuzz, social media is flooded with hashtags, and everyone seems to have an opinion on this unstoppable force. The excitement is palpable, and the fear of missing out is driving more and more people to jump on the bandwagon. Everyone's piling in, riding the wave of euphoria, convinced this bull market will last forever. The trading floors are electric with energy, and every uptick in the stock price is met with cheers and high fives. Investors are celebrating their gains, and the atmosphere is one of unbridled optimism. It's as if the good times will never end, and the stock will keep climbing indefinitely. But what goes up, my friends, must come down. The stock market is like a roller coaster, thrilling and exhilarating on the way up, but inevitably, there are dips and drops. The charts start to show signs of a peak, and the once unstoppable rise begins to falter. The initial excitement gives way to a sense of unease as the reality of market cycles sets in. Traders, those savvy veterans of the market, know this all too well. They've seen it all before, the booms and the busts, the highs and the lows. With years of experience under their belts, they can read the signs and anticipate the shifts. Their eyes are glued to their monitors, analyzing every bit of data, every trend, every anomaly. They discuss strategies and share insights, always staying one step ahead of the game. They've been riding the wave too, but they're also keeping a close eye on their exit strategy. They know that timing is everything, and they're prepared to act swiftly when the moment is right. They set their sell orders, plan their moves, and ensure that they can lock in their gains before the tide turns. It's a delicate balance of risk and reward, and they navigate it with precision. And when the time is right, when they've made a tidy profit, they start cashing in their chips. It's a moment of triumph, the culmination of careful planning and strategic execution. They click the mouse, execute the trades, and watch as their accounts swell with the fruits of their labor. Celebrations ensue, with champagne toasts and a sense of accomplishment. They've played the game well, and now it's time to reap the rewards. This wave of selling pressure creates a drag on the stock price, causing it to pull back from its lofty heights. The once euphoric atmosphere starts to shift, and concern begins to creep in. The charts reflect the change, showing a decline as the selling pressure mounts. It's a natural part of the market cycle, but it can be jarring for those who were caught up in the frenzy. It's not always a crash, mind you, but it's a stark reminder that even in the most exuberant bull markets, what goes up must eventually come down. The market fluctuates, and those fluctuations are a reminder of the inherent risks and rewards of investing. Traders reflect on the trends, learning from each cycle and preparing for the next. It's a continuous journey, navigating the highs and lows, always with an eye on the horizon. The dangers of hype. It can inflate a company's stock price beyond all reason, creating a bubble just waiting to burst. We've seen it time and time again. A company bursts onto the scene with a revolutionary product or a groundbreaking technology. Investors, blinded by the promise of riches, pile into the stock, driving its price to dizzying heights. But then, reality sets in. Earnings disappoint, growth slows, or the company fails to deliver on its lofty promises. The hype evaporates like a mirage in the desert, leaving investors holding the bag. The stock price craters, a painful reminder that fundamentals, not hype, drive long-term value. Now, let's talk about the big players, the institutional investors, the hedge funds, the whales of Wall Street. These guys move billions, and their actions can send ripples across the entire financial ecosystem. When they make a move, everyone pays attention. But what happens when these giants get nervous? The whole market feels the tremors. Imagine a scenario where uncertainty grips the market. It could be a global pandemic, a financial crisis, or even just a whiff of recession. Suddenly these big players need to raise cash. They start selling their holdings, even the good stuff, to shore up their liquidity. This mass exodus of capital creates a vacuum, sucking the air out of the market and sending stock prices tumbling. It's like a domino effect, with each falling stock triggering another, until the whole market is awash in red. These institutional investors and hedge funds are not just any players, they are the titans of finance. They have the power to move markets with a single trade. Their portfolios are vast, often encompassing a wide range of assets from stocks and bonds to real estate and commodities. When they decide to sell, it's not just a few shares here and there. We're talking about massive sell-offs that can amount to billions of dollars. And when they get nervous, the whole market feels the tremors. Imagine a scenario where uncertainty grips the market. It could be a global pandemic, a financial crisis, or even just a whiff of recession. Suddenly these big players need to raise cash. They start selling their holdings, even the good stuff, to shore up their liquidity. This mass exodus of capital creates a vacuum, sucking the air out of the market and sending stock prices tumbling. It's like a domino effect, with each falling stock triggering another, until the whole market is awash in red. It could be a global pandemic, a financial crisis, or even just a whiff of recession. Suddenly these big players need to raise cash. They start selling their holdings, even the good stuff, to shore up their liquidity. This mass exodus of capital creates a vacuum, sucking the air out of the market and sending stock prices tumbling. It's like a domino effect, with each falling stock triggering another, until the whole market is awash in red, or even just a whiff of recession. Suddenly, these big players need to raise cash. They start selling their holdings, even the good stuff, to shore up their liquidity. This mass exodus of capital creates a vacuum, sucking the air out of the market and sending stock prices tumbling. It's like a domino effect, with each falling stock triggering another, until the whole market is awash in red. They start selling their holdings, even the good stuff, to shore up their liquidity. This mass exodus of capital creates a vacuum, sucking the air out of the market and sending stock prices tumbling. It's like a domino effect, with each falling stock triggering another, until the whole market is awash in red, to shore up their liquidity. This mass exodus of capital creates a vacuum, sucking the air out of the market and sending stock prices tumbling. It's like a domino effect, with each falling stock triggering another, until the whole market is awash in red, sucking the air out of the market and sending stock prices tumbling. It's like a domino effect, with each falling stock triggering another, until the whole market is awash in red, and sending stock prices tumbling. It's like a domino effect, with each falling stock triggering another, until the whole market is awash in red. With each falling stock triggering another, until the whole market is awash in red, until the whole market is awash in red. Now, before you swear off stocks forever, remember this: not all triggers lead to declines. In fact, sometimes what seems like bad news can actually be a catalyst for positive change. The market is a complex entity, often reacting in ways that defy conventional wisdom. It's essential to understand that the stock market is not just a reflection of the present, but a prediction of the future. Investors and traders are constantly analyzing data, trends, and potential risks, trying to stay one step ahead. This forward-looking nature means that the market often prices in bad news long before it becomes a reality. Sometimes the market surprises us. It can react positively to news that, on the surface, seems negative. This is because the market is always looking ahead, anticipating future events and adjusting accordingly. For instance, a company might announce layoffs, which seems like bad news. However, the market might interpret this as a sign that the company is cutting costs and becoming more efficient, leading to a rise in stock prices. It anticipates risks, pricing them in before they even materialize. This forward-thinking approach can lead to unexpected outcomes. For example, if there's news about potential regulatory changes, the market might initially react negatively. But if investors believe that the long-term impact will be beneficial, they might start buying stocks, leading to a rise in prices. Take the AI hype of 2023, for example. The market was abuzz with excitement about the potential of artificial intelligence. Despite concerns about overvaluation and the possibility of a bubble, investors were optimistic about the transformative power of AI. They believed that AI would revolutionize industries, leading to increased efficiency and profitability. Despite concerns about overvaluation, the market shrugged off the naysayers, driven by the transformative potential of artificial intelligence. Investors were willing to overlook short-term risks because they believed in the long-term benefits. This optimism was reflected in rising stock prices, even in the face of negative news. Why? Because sometimes, the fundamentals are strong enough to outweigh the negative triggers. Companies with solid earnings, strong balance sheets, and innovative products can weather the storm. They have the resilience to bounce back from setbacks and continue growing. These are the companies with solid earnings, innovative products, and a bright future. They are the ones that investors believe in, even when the market is volatile. Their strong fundamentals provide a cushion against negative news, allowing them to recover quickly and continue their upward trajectory. They weather the storms, emerging even stronger, their stock prices reflecting their resilience. This resilience is a key factor in long-term success. Companies that can adapt to changing conditions and continue to innovate are the ones that thrive in the long run. So don't despair when the market throws a curveball. Volatility is a natural part of investing. It's important to stay calm and not make hasty decisions based on short-term fluctuations. Instead, focus on the bigger picture and the long-term potential of your investments. Remember, it's a marathon, not a sprint. Investing is a long-term game, and patience is key. Just like a marathon runner paces themselves to reach the finish line, investors need to stay focused on their long-term goals and not get distracted by short-term noise. Focus on the long term, invest in quality companies, and you'll come out ahead. By staying disciplined and keeping your eye on the prize, you can navigate the ups and downs of the market and achieve your financial goals. So, the next time you hear bad news, remember that it might just be the catalyst for future success. Remember folks, stocks decline after triggers due to human psychology, not physics. Fear and greed drive the markets, and understanding those emotions is key to navigating volatility. Take MLGO for example, a 488% surge. That screams speculation, not sustainable growth. Prepare for volatility, not miracles. And as always, this is not financial advice. Do your own research, consult with a professional, and remember, in the words of the great Kenny Rogers, you've got to know when to hold 'em, know when to fold 'em. Stay informed, stay disciplined, and stay bullish.